DC Palter, thanks for joining.
Thanks, Mike. Should I call you Michael or Mike?
That's fine. That's fine. No, Michael's fine. Honestly, I feel like some people either they know a jerk who's a Mike or they know a good Mike. Same thing for Michael. So it's like I leave it up to like your basis of memory. Do you know a good Mike or Michael? I'll be that.
That was good.
Yeah. No, it's fine. But no, for the sake of the podcast, yeah, Michael's fine. Thanks again for the money. Hey, just real quick, I'm going to be, you had an article that you put out, and I may be paraphrasing just a little, but the title was something along the lines of, for VCs to get the hell out of pre-seed investing. Was it,
yes.
Is that somewhat accurate to, or am I embellishing a little too much?
No, that was about right. Yes. It was one of my rants of, I was getting frustrated with the VCs. So traditionally, angel investors, so there'd be friends and family around, and then there'd be the angels, and then there would be the VC, early VCs, and then there'd be the later VCs. And it's kind of a system that worked, and angels kind of knew their place, where what we could invest in, where we could provide benefit. And then the VCs started saying, well, we want to invest in earlier stage too. We're going to get into pre-seed. And everyone's like, okay, that's great. More money's better. More startups, we can get things going. Except they have a very different mentality than the angels do. And money is great, but they still had the attitude of, this is kind of like a down payment, because what we want to do is get you to the next stage where we can give you more money. And all the startups like, that's great, money and just gets us to the next stage. Wonderful. The problem is, and that very early stage where probably 50% or more of the startups need to be weeded out, they're not doing that, right? So they're investing in things that aren't ready for investment. And they, one of the things about my angel group that's wonderful is we have 400 pairs of eyes that are looking at each investment. And so you get people with industry expertise, you have people with the all of the different sector specific expertise, so you can get really deep into some of these companies and figure out, do they have something unique? Do they have something better? Do they have something different? Do they know how to put together a team? Do they know how to put together go-to-market strategy that's going to work in this industry? And the VCs typically, especially the ones who are going to do early stage, the team is maybe 5 people, maybe at most 10 people. And they're really just looking at, are they going to get to that next stage where we can do our real investment? And so they're investing in a lot of things that shouldn't be invested in, and they're putting a lot of money in, and that's raising the valuations. And so it's really making it impossible for angels to invest. And so the VCs are, if they're going to invest in things at higher valuations that just don't make any sense to us because they don't care about the valuations, then we can't invest. And so suddenly now all the angels are going to leave the early stage investing, and that's just going to leave it to the VCs. But they don't have the expertise for it. They don't have the number of eyes. And, so they've got money and it's great, but they're not putting it into the companies that need it. And it's killing the ecosystem. And the startups think, oh, this is great. Money's great. We know what we're doing. We'll get you to the next round. But they don't have the time to work with these startups. And so kind of pushing the angels out, I think really in the long term hurts the ecosystem. So what we had before worked. And now this kind of invasion of VC money is kind of throwing everything into a mess that is making it hard for angels to continue investing.
Makes a lot of sense. And that article, the message really came across. A lot of what you're saying now, which I thought made a lot of sense, is very actionable. And honestly, it laid everything out pretty clear. Now, DC, for those that don't know, is one of the top contributors to the Entrepreneurship Handbook, Medium publication. DC's has some great articles on there. I'll actually post some links after the pod. Some of these you definitely have to read, especially for folks seeking early stage seed and pre-seed investments. So DC, you're super qualified to speak on this matter. Can you just give us a little bit of background about who you are and what kind of led you to want to invest in seed and pre-seed investments? Just give us a little bit of a background on how you kind of fell into this.
Sure. And anyone who looks at my LinkedIn profile will they kind of look at it and say, well, what do you do? And my answer is, well, it depends on the day. And that's great. I actually enjoy wearing a lot of different hats and doing a lot of different things, but it is confusing even for myself. So I started off as an energy engineer, worked at big companies, worked at GM, worked at Honeywell, ended up working in a Japanese steel company. Loved that. And I spent a long time over there. But at some point, I wanted to get back to the business side of technology. So I went back up my MBA, and it was the mid 90s. And lo and behold, dot-com bubble, and it was all startups. And so I ended up at a startup. And that just opened my eyes, changed my world. It was like, wow, instead of doing one little thing for years on end, you can do 10 different things every day, and you can make a real difference. And if you succeed, you actually not just make your help your boss, but you actually get some financial rewards out of it. So like, why would I not want to keep doing startups? So I spent 25 years doing startups, mostly in the IT space, but then kind of branching out into kind of other things. I've had some successes there, which gave me the flexibility of starting other startups, but also spending some time giving back by investing in other startups. And what I found as an angel investor, I've been angel investing since 2009, was that the investors and the startups were speaking a different language. And the investors really, the startups really didn't understand what the investors were looking for. And so their pitch decks followed the template, but they didn't really resonate with investors, except for the ones that have done it 2 or 3 times and kind of have been on the other side. So I took it upon myself to say, we need that bridge between the startups and the investors. And so I became a very active mentor, and I would go to a lot of accelerators and be part of kind of startup organizations and say, here's what your pitch deck looks from an investor point of view. So wonderful, beautiful deck, great product. Where's the investment, right? Why is it, you got to tell me it's a great investment, not you have a great product, and things like that. So I started doing that. And what I found, no surprise, was it was the same mistakes over and over again. It was the same questions over and over again. It was the same, how do I do this over and over again? And kind of being a writer by heart, I said, well, why am I doing this one-on-one? And I'm not even very good at explaining things on the fly. Why don't I just start writing it down? And I started writing articles, and I posted it on my own blog site called pitchingangels.com, still there. But nobody read it except for the people I said, here's your question. Here's my answer. I'll give you the summary, but go read it afterwards. And then I found Medium, and I took my articles and I put them on Medium, and nobody read them. Because you just post articles on Medium, it's not like people are going to find them. Just like blogs, you post a blog and no one's going to find it. It's not like Google's magically going to, bring you 100,000 readers. So I started, a publication found me and said, this is great content. Can we put it in our publication? I didn't know anything about publication. I said, sure, why not? Whatever. And suddenly I went from having 100 readers to having 10,000 readers. And I'm like, that's how Medium works. You can use it as a personal blog, but you want readers, you have to be part of the publication ecosystem. So I started submitting my articles to publications, and very quickly found Entrepreneurship Handbook. And it's like, oh, this is the publication for me. This is where my articles belong. This is where my readers are. And so we've had this very great relationship where I will write articles about what founders need to know. And well, where are the founders on Medium? They're on Entrepreneur's Handbook. So I submit them to you guys, and you guys do a great job getting it out to your readers. So thank you very much for that.
Absolutely. And shout out to Dave Schools for putting that together and really pushing that program there, that publication. So I do want to get into, you mentioned something around, you were involved in a lot of like reviewing of pitch decks, and you saw these kind of constant mistakes that were made over and over again. I do want to hit on that. But just to, while we're on the Medium topic, you mentioned, I just want to know maybe the audience wants to know some like growth kind of hacks. You mentioned one, like publish articles for other bigger publications. Is there any other advice you have for, Medium writers to really get their name out there, establish their brand, build these type of partnerships? Any advice you have around that strategy? Yeah,
that's a really good question, because I've been relatively successful with your guys' help on Medium. That it's generated, not a lot of money, but enough to justify what spending some time writing is, but I like it as well. So how do you become successful writing on Medium? Well, the tricky thing, like Medium or like dealing with Google, is every few months they change their algorithms and they change their philosophy, and what worked 6 months ago doesn't work anymore. So what works right now is boosting. If your article is not boosted, you probably won't get any traction. And other than your own followers and your own people that you've posted to on places like LinkedIn and Twitter, you're probably not going to get a lot of reads. So you have to get boosted if you want to get a lot of readers. The best way to get boosted is to, number one, write well. The Medium got a lot of was getting a reputation for a lot of crappy writing, and they've kind of tried to solve that by saying we're only going to push articles that are well written. So write good articles, write interesting articles, write informative articles, and you have a shot at getting boosted. And then number two, submit it to a publication like Entrepreneur's Handbook that does have I don't know what the official term is, but the right to or the ability to recommend articles for boosting. And so they'll recommend it to, and there's actually, I guess, people who read them and decide at Medium whether they're going to boost it or not. So it has to be recommended, and then they have to approve it, and then it gets boosted, and then it gets out in everybody's feed and you get lots of reads. If you don't, it's probably just going to languish. But the other way to help the process is to have a lot of followers and to and to bring a lot of readers in from the outside. So write your article, post it, get it submitted, but also get your followers on X and on LinkedIn or on Instagram to come over and read it as well. And whether that's the algorithms or the humans that see it, it's like, oh, you got 1,000 readers already? Of course, it must be, we're going to boost that. So that helps as well. But first and foremost now, and this wasn't the case 6 months ago, it's got to be written well. It can't be sloppy. It can't be boring. It can't be there's way too many listicles. It has to be useful content. So, and 6 months from now, it's probably going to change again. But that's the way to work the system today.
Got it. Makes a lot of sense. Okay, so no straight chat GPT content that we could just repurpose.
No. They are absolutely trying to weed out anything written by AI.
Fair enough. Thank you for those tips. Super helpful. So going back to some of the mistakes that you made, or not that you made, but that you've seen other, founders make in their pitch decks.
Too, but yes.
We all have, indeed. Yeah. Yes. So what are some of those factors that, some of those mistakes and factors that you use to consider when, evaluating pre-seed startups?
Yeah. So number one mistake I see on a pitch deck is kind of what I was hinting at before, that we're not customers, we're investors. And what you need, when you give us a pitch, you are selling something. You are selling stock in your business. Why are we going to buy that stock? Well, we're investors. We're going to buy that stock for the same reason we buy Apple stock, not because we love Apple products, but because we think that stock is going to go up in the future. Well, how are you going to convince us to buy stock in your business? You have to convince us that 10 years from now, that's going to be worth 100 times what it is right now. Otherwise, I'm going to put my money in S&P index funds, or I'm going to buy Apple stock, right? So you got to convince me that this is a good investment. That's first and foremost. And so that means don't tell me how great a product you have. Yeah, you got to have a great product, but you need to have a product that you can then build into a business that's going to grow exponentially. I mean, having a good, solid, profitable business is nice, but that's not going to work for venture investment. It's going to work for individual investment. It's going to work for operational investment. It doesn't work for venture investment. You need to grow to $100 million in 5 years. That's kind of the benchmark number. No one ever actually hits that number, but that's got to be the plan. That's got to be the goal. And you have to show how you're going to do that, right? There's got to be a big enough market. There's got to be a plan that's going to get you there. And then the reason you have to grow so fast is because within 5 years, maybe 7 years, somebody's going to acquire you. Or you're going to do an IPO. But most of the time, it means somebody's going to acquire you. It's going to be an industry giant, and they're going to acquire you for some outrageous amount of money. And then all the investors are like, woohoo, we made a lot of money. So we can take that money and invest in a whole lot more startups in the next round. But kind of, I see a lot of plans that say, oh, well, we're going to build a good, solid, profitable business. Well, that's nice. I love good, solid, profitable businesses, but they're not investments, right? Those are something for you to build. I see a lot are just like, well, we have the greatest product in the world. And I'm like, okay, but I'm looking for the greatest investment in the world, not the greatest product in the world. So you have to tell me a story. You have to tell me a story how you're going to build a great product that's going to build an exponential business that's going to get to $100 million. And then Google is going to buy you out for $2 billion and I'm going to get a 100x return on my investment. And that's what I want to hear. And I rarely hear that. And that's kind of fundamental. And everything else in the pitch deck goes into showing how that's going to happen, how that's going to be a great business, how you're going to actually succeed, how you're going to keep out the competition, how you're, who's going to acquire you and why they're going to pay such a large multiple when they can do it themselves, right? So that's what we're looking for in a pitch, and very few people do that. So the second tip, that was probably plenty. The second tip is keep it simple. I see a lot of pitches, especially early stage, that are packed with information. And that's great. You're going to answer every question I might have. Well, you got 7 minutes, maybe 10, maybe 5, but on average, 7 minutes to answer a lot of questions of everything I just said. How are you going to do all those things to get to $100 million and get me my 100x return on investment? And, it's everything from, the obvious, problem, solution, market size, competition, revenue projections, team, moat, exit strategy, terms. There's a lot of stuff to cover in 7 minutes. So you can't cover everything in detail. We're not expecting you to cover everything in detail. You're just going to overwhelm us with the detail. So your pitch is almost like an elevator pitch. You got 7 minutes to get us excited about why this is the greatest investment in the world, so that we're like, okay, this sounds really good. Tell me more. Let's have a 2-hour meeting. And next step is a 2-hour meeting. So you don't need to answer all the questions we're going to ask in the 2-hour meeting. Just get us excited about the fundamentals so that we're like, yeah, we want to have a 2-hour meeting. 2-hour meeting, you're not going to answer everything. That is to really get into those details and get us excited so that we then go into diligence and answer all the questions. So don't try to do too much. Don't try to pack everything in there. I tell people no more than 30 words on a slide, and that kind of shocks a lot of people because they have 500 on the slide. And everything on the slide, everything in the presentation should be just at a glance, I got to get it. Because if I'm reading it, I'm not listening to you. I just need to get it. One concept, maybe a couple bullet points that emphasize it. A lot of graphics, not clip art, but graphics that actually are telling that story. And really, I think in just that 5 minutes, I summarized everything I've done in 100 articles for Entrepreneurship Handbook and everything I tell people in the accelerators. So that's what we're looking for.
No, so amazing. Those are great tips. And that's super helpful for obviously the founders on the receiving on your end, on the investor side.
Yep.
How are you balancing the high risk versus the high reward paradigm? It's it must be super challenging. And how do you evaluate those two? Obviously, just being so early on in the business's story. How do you balance that risk versus reward?
That's the key to it, right? It's risk versus reward. And it's we know. So out of 100 pitches we hear, we'll probably invest in 2 to 3. And of those 2 to 3, 90% are going to fail. And we know 90% are going to fail. So we're looking for the one that's going to succeed, which is why we need that 100x return on the one that succeeds to make up for the 90% that failed and still get a decent return on our portfolio. But how do we evaluate that is really a tricky question, and you'll hear different answers. You'll hear people, we bet on the jockey, not the horse, or it's all about the team, or it's all about the product, or we look for a vision. For me, it's all the above. There's a reason why there's 11 slides in the pitch deck, and there's a reason why it includes competition, why it includes intellectual property, why it includes your 5-year revenue projections. It's not like we're just asking for random information. This is the information we need to see to get a idea of whether this is a viable chance to get to $100 million and get a huge acquisition, or whether it isn't. So we need all of this information. We need to put it together. But here's the answer most founders don't want to hear. And I'm sorry to have to say this, but I find myself saying it a lot. I think a lot of people who come to entrepreneurship, they have this idea of, well, I've got this great idea. I'm going to put together a pitch deck. I'm going to take it to the VCs. They're going to give me $10 million, and I'm going to go build the team and build the product, and then we're all going to be rich. And they've heard, the stories of successes like that. And those successes, unfortunately, are people who already have, they've done it before. They have connections in the industry. If you've made $1 billion for Andreessen Horowitz with your last startup, yeah, they'll give you $10 million to do whatever you want to do. But for everyone else, that's not going to happen. And the process is really to get as much validation as you possibly can. The more validation you have, the lower the risk, the more the easier the investing becomes. And what we really, really, really want to see is revenues. Not a lot of revenues, but we want to see customers. We want to see people using it. We want to see repeat customers. We want to see that it solves somebody's problem. They're willing to pay money for it, and it's easy. Once we have people using it, we want to talk to them, right? Did this solve your problem? How, what are you doing? What problem did you really have? And why did you not use one of the competing solutions? And how many more people are there out there that are just like you? So if you have revenues, even if it's only a small amount, that solves that's a game changer, right? Pre-revenue and post and in revenue startups are just different investing process, different investing philosophy. And I think a lot of angel investors, the professional angel investors who are investing to make money out of it, will not invest in startups, pre-revenue startups. At that point, it's an idea. It may be a great idea. All the ideas are great. All the pitch decks are great. But which ones are viable? Well, they're the ones that have already built a product and brought it to market and have started to have customers. And now they just need money to kind of build it out and add the feature set and make it more professional and do the marketing and sales and grow from there. But before that, it's really tough. And so then everybody says, well, but I need the money to build the product, right? That's what I thought investors were for. But most investors that you talk to are going to be like, sorry, you're too early. Come back when you already, when you start having some revenue. Or if it's B2B, it may not actually be revenue, but at least, pilot programs or things like that where you're with customers. And so before that, well, there's friends and family money. There's consulting. There's working. If it's software, you can kind of do it in your spare time. You can maybe put together a little bit of money and hire a few part-time people to fill out some things you can't do yourself and bring it to market. If you're in chemistry, like new batteries, it's really tough. You need $2 million just to get it out of the lab and into customers. Then you need to look at things like government grants. You need to look at customer NRE, at prepayments, at people in the ecosystem who aren't investing strictly financially. They're investing because they know this product is needed. They want to support this product. They want to see it. Maybe it's a product that's going to help them as well. So you talk to suppliers, you talk to partners, you talk to distributors and resellers, and don't just partner with them, but see if they'll invest or introduce you to other investors because they know how important this product is. When you just do a pitch in front of a whole bunch of people that are probably like real estate people or retired lawyers, they don't know the industry. You're convincing them to buy stock in your business. So you need to be talking to people who are in the industry, who know what you're doing and want to see this succeed. And it's more about bringing something to market than it is about, well, how much is my investment going to be worth in 10 years? So it's a different investor group, but the further you can get along to having revenue, to having customer validation, the easier the raise becomes.
That's interesting. I think before the idea of being pre-revenue, I don't know if it was just an idea. A lot of founders maybe thought it was sexy. Maybe it was a time period where like no one, reporting revenue may limit the value of your company based on the valuation of what it actually could be. Was that something that was just a trend, or is it very conditional based on like even speaking to like today? Is it a very conditional thing where it depends on what industry you're involved in, or is it still relevant, or when is a good time to consider being seeking investment when you're pre-revenue?
Personally, if you don't need the money, don't take it. Don't go asking for it. Go build the product and get it out to market, and then go get your money to like hire 100 salespeople once you've already got a lot of customers. That's not most people can't do that, so they're going to need money at some stage. And the question is, how far can you get before you have to take investment? So my recommendation is always go as far as you can, bootstrap as far as you can until you get to that inflection point where it's just like, we've proven it, but now I need to hire 20 people, and I can't do that organically. So I need to get money. There, a couple of years ago, it was kind of a bubble. People were throwing money at everything, and some of the things they threw money at were insane. So there were a lot of like jokes about it and farce about it. But you're right. If you don't have any revenues, your potential is infinite, right? And once you start turning it into something real, then people can say, well, prove it to me now. I didn't invest in any of those. There were people who did, but I think those people have seen the error of their ways and have gotten out of angel investing. So the people now are a lot more, show me, prove it to me. And the more evidence you have, the easier it is to raise money.
Got it. Yeah, and that goes to speaking towards the the kind of current market conditions around pre-seed and angel investments. Yeah. What and you have a really good article that I read before the pod. It was startups stop waiting for the return of 2001 and get real. Can you explain just kind of the current market conditions and just kind of the thoughts behind that article?
Yeah, that's kind of the first question. Whenever I talk to founders, they say, what's the current conditions with investors or people investing, and even among angel groups or other investors. When we get together, we have regular social events. The question is, what's going on in the industry? So we're all watching like Crunchbase and other things like that, so we can, we know our own little. We got a little flashlight that looks in our small little area, so we're trying to find out what's going on elsewhere. So what I can tell you, and it's completely anecdotal. Well, before we get to the anecdotal, I can tell you Carta puts out some really great reports on early stage. They put out a quarterly report on early stage status, and they have the best data in the industry because they know what, everyone who's using Carta, every time they raise a round, that goes into Carta, and they can see, who's raising at what sort of valuations, and can compare it to past quarters. So they have some great statistics that show, in 2021, we were in a bubble and it went like this, and it's gone down like this. And now it's still going down a little bit, but it's stabilized is what their data is showing. And so that's really great data to be able to look at, and is fairly consistent with what I've seen. But my anecdotal data, I think, is somewhat interesting. So I'm in a angel investing group I'm actually in two groups, but for this, I'll talk about Tech Coast Angels. So this is your traditional angel investing group that's geographically built in, and every city has at least one of these angel investing groups. TCA Venture Group is mostly people in the Los Angeles area, so we're Southern California, and there's different chapters, but put together is about 400 members, angel investors that are in Southern California, and we invest in companies all over the country, but we do focus on the LA ecosystem. We're kind of a hybrid that we have a member fund. It's a little bit different from a venture fund. A venture fund, LPs from outside give you money, and then you have professional, the employees of the venture fund will, investigate, full-time job, and they will investigate the companies and decide what to invest in. But they're investing other people's money. The way a member fund works is all of the members of TCA. In this case, there's different chapters. So this is specifically about the West LA chapter, which with about 120 members. So every year we put together a fund, and it's our money, and then we vote on what we're going to, when company comes through, it goes through diligence. The fund members vote on whether we are going to invest as a group. So we're collaborating, but it's our money, and we're deciding what we're investing in. But then we will also invest individually. So each year we do a fund, and so 1 year it was $1 million, another year it was $2 million, then it was $3 million, and we usually try to divide it up. So it's roughly about 10% in 10 companies. So when we had $3 million fund, it was the typical investment was $300,000, and we invested in 10 companies, and it generally worked out that took about a year. And so each fund ended up generally being a yearly fund. So we'd start off in January. By December, and we would finish up the fund, and we'd raise the next fund for the next year. So we started off with $1 million fund. In I forgot what year it was, but then the next year it became a $2 million fund, and then we were in 2021, and it became a $3 million fund. And it was, so we were doing $100,000 in 10 companies, and then $200,000 in 10 companies, and then $300,000 in 10 companies. And what happened was, it kept growing, and then the middle of, I guess it was 2021, suddenly we said, no, these valuations are way off, and the bubble kind of burst. And well, actually, we had just finished up that fund, I think, and we started the next fund. And instead of taking 1 year to go through the whole fund, it took 2 years. So we invest, and it was a smaller fund as well. So instead of having 300,000 in 1 year, 3 million in 1 year, we had 2 million in over 2 years. And so that's a big drop from, essentially that's a 2/3 drop. And so that's kind of what we're seeing. So, and that took 2 years. Then we raised the next fund, which was 2 million, and we went through it in 6 months. So now we're opening another fund. So what we're seeing is the pace of investing is coming back again. That it's not 2 years to do to go through 10 companies. It's 6 months to invest in 10 companies. But the amount we're investing in each one is 200,000 instead of 300,000, and add in the individual investment. So it ends up being like 300,000 total instead of 500,000 total per company. So the velocity is increasing again, and we're doing more investments, but we're doing them at lower valuations, and we're doing lower amounts. And I think that is probably typical, across what we're seeing across the industry, that the investments are there, but they're coming back up in speed again. So the number of rounds is increasing, but the valuations are, if you come in with the valuation you had in 2021, we're going to be like, no, we're not. So you're going to have to come in at a reasonable valuation, and then we'll be like, okay, well, we've got money in the fund. We want to invest. It sounds like a good deal, so we'll invest. But we still see ones coming in at 2021 valuations, especially follow-on rounds, right? Where they're like, well, our last round we had a 15 million valuation, so this year we're asking for 20 million valuation. We're like, no, you didn't meet your milestones, and you were overvalued to start with. So if you're lucky, you'll get a 15 million valuation, and really you should be at like a 10 or 12 million valuation. There's a lot of hard conversations going on, and a lot of the rounds now are at the same valuation as before. Nobody wants a down round, so they're like, well, where do I need to get to have the same valuation as last time?
Got it. Yeah, it does kind of, that's what I'm hearing a lot too, just from other, folks in the industry, just kind of this normalizing of the market a bit, valuations, certainly making those adjustments. When founders are looking for, angel investors, what other things should founders be looking for in an investor outside of obviously a check? What other aspects should founders be looking for when partnering up with the right angel?
Yeah, that's a really good question. I hear a lot of advisors say, well, pick your investors, pick the ones that resonate with you, pick the ones that are value add. And I just know too many founders. They're just like, no, I need money, right? I don't. It's great if you're a 3-time founder and you've got this whole network, but I don't have that luxury of choosing 10 out of 100 investors. Anyone who gives me money, fine, I'll take it. So yeah, that's the usual advice of finding the best investors you can. But if you don't have that luxury, you may have to take a check. which is hardly the worst thing possible. But you do want investors that are value add. You do want investors that can be mentors as well as sources of checks. And I guess most importantly, you want investors that you enjoy working with, right? These are people that are joining you on your journey. You don't want somebody who's going to call you up every 10 minutes and tell you you're doing things wrong. You do want somebody who's going to call you up, once a month and say, "How can I help you? You seem to be struggling. I've got some suggestions. Let's chat." So it's got to be somebody or people or an organization that you resonate with. If as much as you need the money, don't take it from somebody or some group that you're not comfortable with. And there are some crazy investors out there. There's a lot of fraud out there. There's a lot of people saying we're investors, and we're going to give you a big check, and it turns out they just want to. They're actual scams where they'll say, well, you have to pay $20K up front for legal fees, and then they take the money and disappear. So you have to be careful with that.
That makes a lot of sense. And it brings up like the idea of just like the terms on an investment. What type of terms are you comfortable operating with certain founders? Obviously, I know it depends, but what should founders be aware of whenever negotiating terms of a deal?
Okay, so that's actually something I've written about a few times, and something I'm very adamant about. So we see different sorts of terms, and so valuation is going to be the most important. It needs to be a reasonable valuation. But I think the vehicle is kind of the first thing we see. What is, and by that I mean, what kind of a structure is this investment? Is it equity? Is it preferred shares? Is it common shares? Is it a safe note? Is it a convertible note? The early stage, the vast majority, and this is out of the Carta data, I think 80 to 90% of pre-seed investments now are safe notes, with the remainder convertible notes. And then in some cases, preferred shares, but they don't count the preferred shares because they say, well, it's preferred shares, then that's not a pre-seed round. But anyway, so sometimes we'll see preferred shares. Usually it's a safe, and sometimes it's a convertible note. Some angel investors will only accept convertible notes. There's still this bad reputation among safes. And there are some groups that say no safes. Now, I've been very vocal in saying the original safe was horrible. I don't know, it just was not a good investment vehicle. It was fine for YC, but it wasn't good for investors. And we shouldn't take that. However, 2018, YC changed it, and now it's much better. And in fact, I prefer it to a convertible note. I guess the answer is preferred shares, safe or convertible note are all fine if this is a critical if, the safe note is a post money safe. So if you're asking for a pre-money safe, we will not invest. If it is a discount only, meaning there is no valuation cap on it, just a 20% discount off the next round, we're not going to invest. Same thing, convertible note. Those are usually pre-money. Post-money is even better, but they're not common. But it can't be uncapped. So no uncapped notes, no pre-money safes, and no common shares. We don't invest in common shares. Anything else is okay as long as they're templates, right? So the terms are pretty standard. We're looking for a reasonable valuation, and then the other terms just being standard.
Got it. And in one of your articles I read, you mentioned also that, having like an LLC is something you probably would say no to.
Right.
The company's structure.
We don't invest in LLCs. If you're looking for outside so this is something I see a lot dealing with startups that are just getting ready to do their fundraising, and they've either had lawyers or accountants who are used to small businesses, and what you have to understand is a startup is not a small business. It is an embryonic big business. And it needs to be structured like a big business. It needs to do the accounting like a big business. And so an LLC is absolutely the right thing for a small business. It is absolutely the right thing for my wife's Ikebana business. It is not the right thing for a startup that needs outside investment. There's a lot of reasons, tax benefits, tax complications, structure, that an LLC is the wrong thing. And I have invested in a few LLCs and they turned out to be a big mistake because they need to send me a K1 every year, and then they send the K1 late, and then I forget to put in my taxes. Now I have to redo my taxes when they send me the K1, or they did their K1 wrong and their accountants redo it for them the next year. And now I have to redo my taxes because there's a $10 mistake in your in your K1 form. So I don't want a K1. I don't want to invest in an LLC. I want to invest in a C Corp, and that's the only thing I'm going to invest in. And that's kind of an absolute requirement.
Makes sense. Yeah. And the companies that also you are invested in, do any verticals stand out to you right now? Or is anything exciting that, you're keeping your eye on, or, you have a preference in investing in, or is it kind of across the board?
Well, I'll answer for, what I see in general versus what I like, because they're very different. It's just unusual for me. It's hard to talk about angel investing nowadays without talking about AI. Everything is AI this, AI that. Some of it is kind of like fake AI. It's how do we say we're doing AI when what we're doing is just software, and we've added, maybe we've added some AI capabilities to it. And I don't take that real seriously. I look, okay, well, who's the customer? What are they doing? And fine. AI is a programming method, right? I don't, whether you use heuristics or whether you use AI is just a module that you plug in. I don't really care unless you're actually doing, you're creating AI infrastructure, and then we're investing in AI. So don't, I just get all of these pitches, AI for this, AI for that. It's like, no, that's not really AI. Same thing a few years ago, it's blockchain for this and blockchain for that. I'm like, I don't care. Whether you use a distributed database or a centralized database, it's a database, right? Unless you're actually building the infrastructure, I don't care what I want to know what the tech stack is, but that's not, in the end, you're solving a customer problem. So how you solve it is less important than what you're solving. So yes, nowadays, a lot of AI for this, AI for that. Whether it's actually truly investing in AI is open to question. And then my group used to be 70-80% software, with a little bit of everything else, consumer products and life sciences and climate tech and whatever. Now it is at least 50% life sciences. So we're seeing, it's probably mostly, 50% life sciences, whether that be pharma or med tech. And then software is mostly AI with a little bit of few other things. And then kind of a mixture of everything else, whether that be climate tech or consumer products or, get else in robotics or whatever. It's just a mixture of everything else. Personally, my interest coming from the energy engineering background, what really gets me excited is climate tech and particularly energy sustainability. So mostly when I'm looking at startups, I'm going to focus in on the climate tech ones. I'm going to focus in on things like batteries and water purification and recycle. How you can turn plastics in, recycle plastics or make plastics out of something other than petrochemicals. Those are the ones that get me excited. So like when one of those comes to Tech Coast Angels, I end up being the deal lead for that because that's the ones that I've got some background. That's the ones I'm going to dive into. So I'll help out with the other ones where I have some expertise, but those are my passion and my interest. And those are the ones where I'm going to invest individually if they get through the organization's filters.
Got it. Yes. And obviously the climate is changing, literal climate. So a lot of technology and engineering is certainly going to become more and more values as blessings evolve that way. In the evolving, startup ecosystem, what's the role of the angel investor now and in the future, in your opinion?
Well, it keeps changing, doesn't it? So it depends on how much the VCs are going to keep trying to take over the early space. But I think we had a system that worked relatively well. I mean, there's a lot of reasons why it was frustrating for everybody, but it basically worked that, you'd start off with friends and family grants and, whatever you could to scrap things together. Then you'd have the angels to get you through the pre-seed. And then you'd have the early stage VCs, and then you'd have the big money VCs. And I think we're probably going to move back towards something that's like that, obviously with more accelerators. But the whole thing, the ecosystem is getting larger. There's more people, there's more money going to VCs, there's more angel investors, there's more startups, there's more accelerators. So it just keeps growing. There's more interest among the public. There's more people who maybe would have retired and played golf, and now they're going to retire and do angel investing, right? So I see it growing, and I think that's great, because that means there's more startups that can be supported. And we're seeing, it used to be, my generation, you graduated from college, you went to work for a big company, maybe at some point you went to work for a smaller company, and, maybe if you had this brilliant idea the company didn't support, you would be a crazy person and do your own startup somehow. Nowadays, people come straight out of school and say, I got a great idea and I want to build a startup. And so there's just this explosion of startups. That's actually a challenge. There's so many startups and so many pitches and so many great ideas out there. It's hard to know what to invest in. But I think it's really great to see the whole startup economy really just exploding, and having angels as being kind of that early, not super, not the first investors, but the second round of investors, once you've already kind of built that MVP, is really the space where we're most comfortable.
Got it. Yes. And as like a kind of a takeaway from this conversation, how would you recommend founders actually seek and find angel investors? Like, what
they all seem to do is buy lists or go on LinkedIn and look up angel investor, and then send a 10-page thing in a message on LinkedIn. I'm like, don't do that. The way to do it, we get hit up with probably 10 pitches a day on LinkedIn, and we're going to ignore them if we don't know you. So find people in your space. Find people who are really interested in what you're doing, and it's not just an investment. That can be mentors to you, that have something to add and helping you get started, helping find customers, maybe being a customer. Reach out to those people. Do customer discovery on them. Do investor discovery on them. Those are the people that have something to add, and they're the ones that are going to be most interested in what you're doing, even if they don't invest. So, like I said, when I get hit up with a lot of investments, when something comes through that says, "Oh, I'm working on a new battery technology," I'm like, "Oh, okay. Tell me more about that." Anything else comes through, I'm like, "Okay, well, consumer products, wonderful, sounds great. Go apply to TCA." Or, "Oh, you have this, you have great new med tech product. Okay, great. Apply to chemical angels. Fine." But the ones that I'm going to learn more about are the ones where it's really in my interest. So, if you're doing an ed tech product, look for people who worked at, Blackbaud and places like that. Look for people who've built their own ed tech startups. Really look for that network of people that, not just money, but really can help build your ecosystem, can help get you into the network and help you find customers. And if they invest, great. And if they don't, you still learned a lot from them. So those are the people who kind of do the cold calls for. And then, once you're at the stage where you have some traction, you can show it to everybody. Then, just apply to the angel groups. I mean, you can come to me and say, "Hey, DC, I want to apply to TCA." And I'm like, "Okay, well, go to the website and apply." Like, "Well, we want a warm introduction. We want your help." Like, that's, VCs kind of work that way, but angel groups don't. We have a process. You have to apply. It has to go through pre-screening committee, takes to the screening, and then, then goes through a diligence process, and then the whole membership votes on whether we're going to invest or not. And I can give you some pointers and some tips, but in the end, you're going to have to go through that process. So if you don't need pointers or tips, just go and apply, and I'll see you there. So, there's a lot of angel groups, and they're all happy to have people apply, and you don't need a warm intro. You don't need any sort of connection. So if you're at that stage, just apply. If you're not at that stage, then trying to reach out to members isn't going to get you anywhere. Go find people who have very specific expertise in your industry.
Solid takeaways. Thank you for that. And also, this has been such a great conversation. Lots of really good, good information. And I know when you're not investigating investment opportunities, you're working on books. What are you doing outside of investigating your investments?
Yeah, like I said, people look at my resume or my LinkedIn profile like, what is he doing? He's like energy, but also writing and startups and author and like, okay, so it does depend on the day. But what I really enjoy doing is writing. And sometimes that means writing articles for Entrepreneurship Handbook. And sometimes it means writing stories. And so last year, my first novel came out. It's called To Kill a Unicorn. Guess what? It's about startup. I tell people, forget about all those, lean startup and startup right and all those other things. You really want to have fun reading about Silicon Valley, right here. So this is about a startup that's invented teleportation, but it's such a huge opportunity. That's the end of airplanes. That's the end of cars. That's kind of changed the world, right? It's worth trillions of dollars. So, maybe there's some bugs in the system they're not telling people about, You'll have to see. So one of the scientists is missing, and his friend who works at a company that's suspiciously like Google, that I can't call Google, is looking for him, and he's a hacker. So he does what hackers do to try to find his missing friend. So it's a crazy story, just absolutely crazy story about all the craziness about Silicon Valley. I had so much fun writing that, and the crazy characters and their lives, that I wrote the sequel to it, which comes out. Now it's in here. I guess by the time this goes live, it will actually be out and you can buy it. But right now it's still in pre-release. It's called Countdown to Decryption. So same hacker who no longer works at Google because he was hacking and got caught at it. But his girlfriend's friend is murdered, and she asks him to find out what happened because the police aren't really seriously investigating. And he hacks into her email, because what else would you do to find out what's going on? And the last email that she opened was a message from a terrorist informer saying there's a terrorist attack coming. The plans are attached. Please warn everybody. But he's dead, and she's the only person with the password. And that file is encrypted. And now there's a terrorist attack coming, and he has to get into that file to stop it from happening, or convince the FBI to find a way to do it. So that is the countdown to decryption, because it has to be decrypted before the bombs start exploding. Just to give a little bit more away, there's like a whole conspiracy that he ends up finding that ends up like putting his life in danger, and he has to solve everything. So again, crazy story, less about Silicon Valley, but more about hacking and government conspiracies, and lots of fun to read.
Well, these stories sound like the relief I need outside of work to get the brain off a thing. It's just
That's right.
Outside of tech, get away, but also in it, and also this alternate universe that's like really, mysterious, and there's some great storylines there. So super exciting. Congratulations on the release. And if people want to find you, where can we find you online?
LinkedIn is easy. DC-Palter, I think. And I'm there pretty regularly, but I also have my blog where I have kind of the archives of the relevant articles have been in Entrepreneur's Handbook. It's at pitchingangels.com. So you can find all my advice, everything we talked about here, laid out much more elegantly than when I speak, and hopefully a lot better organized.
Well, this was perfect. Thank you so much, DC, for your time and for being on the pod.
Thank you for having me here, and thank you for publishing my articles.
Absolutely. Thank you so much. Hopefully we have you back again in the future sometime.
Sounds great. Looking forward to it.
Thank you, DC. Thanks, everyone. You should.